China's big banks are in danger as delinquencies are set to rise. I'm your host, Steven Van Metre, and thanks for joining me today. With much of China still in lockdown, the big banks are facing a wave of delinquencies which could topple not only the Chinese banking system, but the rest of the world. Let's start where we picked this story up as China's largest banks signal tough times ahead. 5 of China's largest banks have said the country's lenders face multiple headwinds this year, which will be an understatement, that include the pandemic, global politics, and domestic turmoil in the real estate industry. We're also going to add delinquencies. On Wednesday, the world's largest lender, Industrial and Commercial Bank of China, warned that China faces shrinking demand, disrupted supply, and weakening expectations in its annual earnings report. Agricultural Bank of China signaled the same in its full-year report. China's banking industry is facing, quote, a more complicated and severe business environment, which really is difficult when your entire country is nearly in lockdown. You better believe that it's going to be difficult to do business, for sure. The country's second largest lender by assets. The global epidemic will continue to recur. The easing policies of developed economies will be withdrawn, and geopolitical conflicts will intensify, according to the Bank of China. Meanwhile, the president of China's Bank of Communications said on Friday it would be difficult for the bank to deliver satisfactory earnings this year. China's been battling a resurgence in COVID infections in some of its largest cities, which has led to partial and full-scale lockdowns, which analysts will say will be a drag on the economy. And that is a complete understatement, because I want you to understand this from a banking perspective. When banks lend money out, they actually are receiving back that plus interest, and that interest doesn't exist in the system. There is never enough interest to pay off all the debts. So what you need is a continuous amount of new loans. And well, when you shut down your economy, as we've seen here in the US and other parts of the world, well, people don't have money to pay their loans. They don't have ability to run their businesses, to go to work. And without that, well, they eventually just stop paying on them. The main impact on banks will be rising loan delinquencies among service sectors and among a lot of other ones on top of that. However, corporate bad loans to the real estate sector jumped 98% at Ag Bank as developers continue to smart from stringent debt rules introduced last year. At CCB, real estate bad loans rose 50% on year to 13.5 billion yuan. Since the introduction of 3 red lines rules on debt ratios last year, developers large and small have had cash flow issues. And this is only the beginning of where this is going. And you can see that if things go wrong in the Chinese banking system, that's going to have knock-on effects to the rest of the world. Of course, remember where the great financial crisis started here in the US and how that spread quickly across the rest of the world. But there's one thing a banking crisis shouldn't impact, and that's your portfolio. Today's like today, when the market's down, well, the strategy is working very well. I'll put a link to Portfolio Shield up here in the corner and in the description below. Let's continue on, because the situation in China is only getting worse, and I want you to be thinking from a banking perspective just how bad this is going to be. China Premier warns of grave job situation amid lockdown. Stabilizing employment is key support for the economy, and it's an extremely important part for a debt-based economy that, again, needs not only new loans to service old loans, but needs people working to pay off their existing loans and make payments on them. This is a severe issue, again, facing a country that's in massive lockdown. Chinese Premier Li warned a complicated and grave employment situation as Beijing and Shanghai tighten curbs on residents in bid to contain COVID outbreaks in the country's most important cities. Li instructed all government departments and regions to prioritize measures aimed at helping businesses retain jobs and weather the current difficulties, according to a statement late Saturday, which cited the Premier's comments in a nationwide teleconference on employment. Again, come back to why is this so important to them? Because you need people to be employed to make payments on their loans, because then if they don't, well, your entire banking system collapses. Stabilizing employment matters to people's livelihoods, which is an understatement, as it also is a key support for the economy to operate within a reasonable range. And Li urged businesses to resume production with COVID fighting measures in place, while reiterating the government's policy to promote the healthy development of internet platform companies to support employment. The Premier's warnings on employment came after the nation surveyed jobless rate climbed to 5.8% in March, the highest since May 2020, according to data released by the National Bureau of Statistics. High-frequency indicators tracking jobs suggest a further deterioration in the labor market in April, as China's top leaders last week warned against attempts to question the country's COVID-zero strategy as newly released data for April showed the lockdown-dependent approach taking a heavy toll on the economy. The rolling out of even more intense restrictions over the weekend in Shanghai and Beijing added further to the challenges facing policymakers seeking to shore up growth. And what they're doing is they're going to crush their economy. Now, what we don't know is why this is so important to them. Maybe there's something about COVID going on there that we don't know, but the economic damage from this, when you start to think of this, how it's going to impact the banking system and how the global economy is all linked together, including the global banking system, that the knock-on effects of this are going to be potentially devastating if they can't get out of their lockdown and get their economy turned around quickly. More restrictions are coming as both Shanghai and Beijing increase restrictions on their residents Sunday to achieve the COVID zero goal, with authorities in the financial hub stepping up efforts to quarantine close contacts of people testing positive for the virus. And this is causing a job slump as relentless lockdown measures in China's two most important cities and elsewhere are already weighing on the world's second largest economy, disrupting the global supply chain and stoking inflationary risks. The measures of snarled operations at the world's largest port in Shanghai stalled the activity in major cities, affecting supply chains and businesses from Tesla to Apple. And what you need to be thinking then is what's going to happen when all of this manifests itself in corporate earnings in the quarters to come. When Apple says we can't deliver phones to people who want to buy them because we can't build them, or Tesla can't make cars, or things can't get shipped. It's all going to have major impacts on U.S. corporations, which may explain why the U.S. equity market is heading lower. Let's continue on because the employment subgauges of the official manufacturing and non-manufacturing purchases managers indices both dropped sharply in April, plunging well below 50. Keep in mind, 50 is the mark where it's unchanged from the month before. Below 50 means a contraction, indicating worse job prospects in the sector. The Baidu index, which measures the frequency of searches for keywords, also shows a spike in searches for the word layoff since the beginning of March to surpass the previous peak in February 2020, as clearly people in China are worried about losing their jobs. And financial regulators in China on Sunday called for local banks. See, it all comes back to the banks to boost credit support for residents with flexible employment, such as online shop owners and truck drivers. So again, what you're seeing here is please extend credit to these people, loan them more money. And this is a dangerous game because if you loan people money that can't pay it back, or perhaps can't pay their existing loans back, well, the devastating effects when the whole thing comes toppling down will be seen by the entire world. Financial institutions in the city have lent 72.3 billion yuan to sectors including retail, catering, tourism, and 33.5 billion yuan to material supplier and logistics companies since March, when the latest outbreak started in the city. The regulator also urged banks to allow Shanghai home buyers to delay mortgage payments or just payment plans to help them weather the COVID impact. So here you're seeing banks are lending out a ton of money. The government's forcing their hand and telling people don't pay on their loans. If you can't, you're trying to get the banks to let people not pay on their loan. And again, if they don't come out of this quickly and get their economy turned down, people will stop paying on their loans and the whole system will crater. In fact, as we go forward now into this next piece, you can see that this means that other countries are going to distance themselves not only from China, but from their banking system. As Britain's biggest bank is caught in the U.S.-China crossfire, insurance Ping An wants to break up HSBC 20 years after the global bank invested in its future. The tussle points to the difficulty of doing business in China. That's why the stock rippled through the ranks of the $3 trillion British bank when it emerged. The firm's biggest shareholder was pushing for the most dramatic split in banking history. Ping An, led by Peter Ma, is urging HSBC chairman Mark Tucker to consider options including breaking the firm apart and listing its Asian operations separately on the stock market. In a recent private memo, the Chinese financial giant enumerated a litany of perceived management failures at HSBC, from underwhelming returns to swelling costs. Now, what would the breakup mean? Well, the implications could be vast, as HSBC is headquartered in London but operates across 64 countries and regions, including Hong Kong, Singapore, India, and Malaysia. And in Asia, where approximately half of its 220,000 employees are based, contributed about 65% of the group's reported profit before tax in 2021. Any breakup would cost billions of dollars, and that is really the key here, is a breakup will cost money. And I want you to think about this as not just a banking issue, but you look at companies like Apple and Tesla and the vast number of companies that are having products or parts or something manufactured in China or in Asia where these lockdowns are affecting. Imagine when these companies say, you know what, we're going to move our operations, and when they have to announce at their quarterly earnings call that, oh, by the way, we're taking billions in dollars in charges to move our factories, well, it's going to have a major impact on the equity market. And if we're lucky, China will keep their banking system intact. But if they face a wave of delinquencies, the turn in default, watch out. The whole system's coming down. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.